Good afternoon, ladies and gentlemen. It's lovely to be here in Dhaka. It's actually my first time in Bangladesh, so a new experience for me, and hopefully a new topic that I can share with you today around the digital banking landscape in Asia Pacific. Now, it was very interesting listening before to all of the content associated with where the banks are in Bangladesh. And obviously, it's very exciting that we see there's a new wave of digital banking applications in the country. I understand there's about 51 applicants that have put forward a submission to launch a digitally native bank in Bangladesh as of just the other day. So what I want to do is share some perspectives around the wider Asia-Pacific landscape, give you some updates about what the market landscape looks like and where the various digital banks are on their journey. And some of the perspectives that were shared around the challenges that they face, you should also be able to find out through this presentation. I'll do my best not to block the view, but bear with me as I like to use the stage when I talk through a presentation. So let's have a look at the opportunity picture. This is all about the unaddressed demand in Asia Pacific. And I think when we look at markets like the United States, when we look at markets like the EU, it's a very different way of looking at the opportunity set because, as we know, Asia Pacific is not a homogeneous market. It is one made up of very different countries with extremely different market structures. And in the context of digital banking, we divide it into where we see high unbanked populations, underbanked populations, generally where clients are more underserved, and ultimately to very developed markets where there's high banking penetration, but the view is there something we can do better as banking institutions for our end customers? And you can see here, Bangladesh ranks about second in terms of its unbanked retail population. And in addition to the retail population, I think it's also important to look at the MSME credit gap. So we look at this from the perspective of what is this credit gap relative to the size of GDP. And we can see the market structure dynamics are far from homogeneous across the region, so it varies quite widely. Now, the important thing that was brought up this morning is where is the opportunity then for the digital banks? Because if you have an unbanked population, what about mobile penetration, internet penetration? And what we were having a look at is, well, where is the current bank population and overall where is the mobile penetration within each market? And I think we can see in Bangladesh, it was brought out this morning, that the rate of internet accessibility is actually still quite low, but it is admittedly growing. There are various statistics that we can look at around this, but it's our understanding that the current mobile penetration, or the internet penetration in Bangladesh, sits at around 39%. Of course, you've got other cash apps and tools which sit around above 50%, but I think the growth story in Bangladesh has been one that is quite strong. And I would say the market structure dynamics actually equate to various other markets within the region as well. Now, we had some traditional banking players up here before. And I can tell you, hand on heart, that the problems that customers face across their traditional banking journey is very common to many markets around the region. If we're looking at basically setting up a bank account, whether we're a small business or an individual, we have to travel to the bank, queue up at the branch. We go through an onboarding process, which typically requires paper documentation, quite a bit of back and forth. And then, of course, lengthy waiting times, very insufficient digital offerings, and things that are often very poorly personalized. And I think beyond that, we generally have a feel of a lack of satisfactory remote servicing. Before COVID, actually even in Hong Kong, the experience of dealing with the incumbent banks was nothing short of frustrating and a headache. But COVID really catalyzed the change in consumer behaviors. We could not travel, we could not see each other as we did, and because of social distancing regulations, it was more that the banks knew they had to adapt, otherwise they would die. So as a result of that, there was a big boost to the digital offering. I think in the MSME space, it's also even more painful for a lot of small businesses with respect to their banking journey. Whether it's account onboarding, loan application, or the continuous account and credit reviews that go on, we tend to find a lot of the MSMEs in the region are struggling with really protracted waiting times and very onerous processes, especially in order to secure products like credit. And you can see that even things like an initial account onboarding time, as we saw in many markets around the region, they may take 2 to 4 weeks to get your account onboarded. We often see that being dragged out 3, 6+ months. And of course, it depends on the industry, but the experience is far from glamorous. And of course, loan applications, document requests, other back and forths with your bankers, to the ongoing annual or semi-annual account reviews. So, in summation, the experience isn't good. And why does this matter? Like, why does this actually matter? Let's take a market like Malaysia. So, I'm going to give you 2 market examples here. So, in Malaysia, this is the lending applications by MSME size, all the way from individuals, micro, small, and medium enterprises. And you'll see in the medium blue, that's the proportion of applications that are rejected by the banks in Malaysia. It's over half. Now you think, is it because Malaysia is more of a developing economy? It's different from somewhere like a Hong Kong or a Singapore? Well, let's have a look at Hong Kong. We can see here, in the light gray, these are the lending applications by Hong Kong SMEs that were partially successful, and you can see in the dark gray, the ones that were unsuccessful. So even a developed market like Hong Kong, you have 40% of the MSMEs over the past 6 years that have either been rejected for a credit application or only partially approved. And this is a pain point across many different parts of the world. So all of this paints a picture around, well, we have a problem, so let's enter the digital banks. And when we look at the digital banks, there's obviously various definitions of the way you want to determine a digital bank, but we're looking at it from the perspective of a digital native branchless bank. Not a traditional bank that's very digital, like a DBS, just the pure digital native banks. And we can see across Asia Pacific, there's been various stages of development in terms of the launch of these various digital banks, all the way from consultation, application, through to the ones that have been launched and are now expanding. We see Bangladesh has just finished off the application phase. As I said, over 50 digital bank applications here. Similar stage as Thailand. We've got Vietnam in consultation. And then, of course, most of the developed markets like Hong Kong, South Korea, Japan, and mainland China have fully operating digital banks at this point. So all in all, we actually have over 40 digital native banks that have been launched in the region to date. And what's interesting is some of these digital banks have already closed their doors. You can see the likes of Australia. There were 3 digital banks that were launched there. Judo Bank, which was SME focused, and then we had Zinja and Volt, which were focused on retail clientele. And Zinja and Volt actually both closed their doors quite drastically because they failed to topple the dominance of the big 4 Australian banking giants. So it was not an easy journey. Now, the important thing to look at when you're trying to dissect what do digital banks do is the technology that they're using, and in particular, across the customer journey. So when we break down the customer journey from awareness to onboarding the client, to then engaging, developing products and services that are right for them, maintaining that customer through to data management, you can see all of the digital banks across the region have been using various forms of technology to streamline this customer process and make the customer journey that much more efficient. So in the awareness part, from what used to be banners on buses and ads in train stations, we're now pushing a huge amount of social media and targeted ads, particularly in markets where there's high internet penetration. We talk about onboarding, things like the use of optical character recognition, facial recognition, biometrics, and data verification to streamline an onboarding process to only a few minutes. Gamification to keep people engaged, budgeting tools, social connectivity to bring them back in the platform, different kinds of credit scoring, robo-services, and payment rewards, again, from the product and service offering. Now, I'm going to give you some examples of key developments that have happened across each of these stages, just to give you a little bit more color. So let's go to Hong Kong. So in Hong Kong, we launched 8 virtual banks in 2020. And you can see all of the efforts being used by these virtual banks are very much geared towards digital marketing and digital channel awareness. From influencer marketing to reward schemes, social media, huge push, and then SEO, ASO optimization to rank up the top of people's apps or on their home pages when they're looking for ads. The onboarding, super lightning fast. So from what used to be a very painful process, I set up one of the bank accounts in Hong Kong. I remember taking a photo of my face. I remember taking a photo of my ID, entering a phone number. Voila, my bank account was set up. The record time with one of the banks in Hong Kong, 2 minutes and 3 seconds. If you go to markets like Philippines, I remember Uno Bank was touting its fastest onboarding time was about 1 minute and 20 seconds. Now you compare that to a traditional banking experience, fundamentally night and day. We look at things like gamification. Admittedly, banking apps or a bank is not a place where you want to spend all of your time, effort, and energy. There are other things that are slightly more interesting to do. But some banks have gamified that experience. If you look at one of the leading digital banks in Hong Kong called ZA Bank, they created what's called a ZA Quest, so mobile phone games, experiences, where you could complete different kinds of quests within the banking app, and by virtue of doing so, you would basically be rewarded points, other rewards, capsules, avatars, things that would keep you a bit more engaged and wanting to use the banking app, as opposed to going in, making a payment, applying for a loan, and leaving the app itself. The whole design here was, how do you get people sticky and engaged with using something that would otherwise be quite one-off and boring? Budgeting tools. So here you have another bank in Hong Kong called Mox. So they wanted to create a platform or a program called Generation Mox. Let's develop budgeting tools for our customers to hit their savings goals. And their collective savings goal target is around 660 billion, or you're looking somewhere in the vicinity of about 85 billion US. So they're all working very hard to build up that deposit base, so therefore they can extend their balance sheet. Now, what does the journey look like for these banks? There's nothing rocket science about the way the development process tends to work. If you look in the retail banking space, it typically starts with, let's attract customer deposits through savings account, time deposit account. Let's bring as many customers on board with high interest and rewards, even payaways and setup fees. Then that typically moves on to a payments-led offering, whether it's debit, credit card, cash withdrawal, virtual cards, QR-enabled payments. And most banks understand that the payments data is actually really key to credit scoring. If you understand the behaviors of your customers with respect to where they transact, how they transact, and how much they transact, you can use this as a basis to start offering personal loans or products like buy now, pay later. Of course, as the maturity tends to evolve, investments, insurance products, and ultimately looking at other adjacent financial services or social offerings. And that's really the journey towards being a super app. So again, I take Hong Kong because it's probably one of the more mature markets in Asia with respect to its virtual banks. And you can see from that product curve, the actual offering is not too bad. There's still quite a long way to go, but most of the banks are starting to roll out their wealth, insurance, brokerage products at the moment. And these are the things that tend to create stickiness, and they're more fee-based in nature. Others have made the choice to steer clear from that and focus more on a balance sheet-led business. The interesting kind of dichotomy here is a lot of these virtual banks understand that key to their valuation is to get the credit risk off their books. And that's always a very peculiar thing. As a bank, you don't want the credit risk on your book, No, we want to be valued more like a tech company, so we actually want to steer away from price-to-book ratios. Investors don't like that credit exposure at the moment. Value us as something different. On the MSME front, similar kind of journey, deposits, payments, lending. Usually that evolves into other products like different kinds of revolving loans, supply chain financing, through to treasury-related products. That's where the insurance and investment proposition comes in. And then the operation side of it is usually around employee records, payroll management, accounting. There's other things that the MSME journey entails. And again, I would say that's a lot more nascent for the various banks in the region vis-a-vis where the retail banking offerings are. Credit scoring is absolutely crucial to the way that many of these banks are operating. When you're operating in emerging markets or markets with a lot of gig workers, you don't have the same kind of employment proof, salary records, deposit slips, things that a traditional bank would be able to offer you a loan on the back of. So you need to effectively crawl through people's metadata. Now, we spent a lot of time working with the buy now, pay later firms when they first started launching. And I'm sure many of you know the buy now, pay later businesses. And what they used to do is scroll through and crawl the metadata on your phone. They would look for things like, do you have other gambling apps? They would look at your phone records. They would look, do you have other lending applications? Things that would send signals about your trustworthiness as an individual. So it became a very fascinating area of development in terms of leveraging data analytics, AI, and ML to understand the kind of data that was going through their systems. And again, this wasn't just traditional data now. It was very much geared towards alternative data that banks started to look at. And again, at this particular point in time, I think the evolution of the banks here is, again, a little bit more nascent in Asia Pacific. How are they making their money? It's still typically interest and fee-based income. If you look at some of the models over in the West, so a Revolut, a Monzo, an N26, a lot of them use subscription-based pricing models. So you have a freemium-based model, you pay X fee, you pay a bit more as a subscription, and then of course, you get more services, more products, more offerings. There's obviously trade-offs when you're looking at this. This is great to start the journey. You usually switch that on a little bit later. It creates a lot more stickiness around your revenue base. But again, customer propensity to pay is very important to determining which model actually will work and be sustainable. Maintenance. So again, you're seeing what are the maintenance models? How are these banks dealing with customer queries, complaints, questions, all of that? So you've had this evolution of different tools like chatbots, your 24/7 hotlines, your live chat tools. Gen AI is going to become a lot more interesting in terms of its application in this space to create more nuanced, human-like, personal responses. So we will probably see this start to evolve. The irony is a lot of people hate chatbots. Often they want to speak to a human being when they're making a complaint, not type a complaint into an app. And then I think one of the real game changers is the underlying infrastructure that supports the data management, which is cloud infrastructure. So a lot of the banks, well, you saw, start to launch their services on the cloud, and particularly third-party public cloud, the most scalable, cost-effective way that you can manage it. The reason why many of the banking institutions were not able to do this, and different jurisdictions in Asia Pacific are facing challenges, is it's usually the regulatory appetite with respect to keeping data on-prem. So I think as we start to see regulators open up more to the idea of using public cloud infrastructure, or even sustainable and scalable private clouds, the pace from which you can do product development and engage with your customers will be that much better. And hopefully, it's something that Bangladesh takes note of as well. Last two slides with respect to this part of the presentation is around the partnership ecosystem. So partnerships are really, really critical in terms of not only scaling into new customer segments, but also developing new products, collecting new data. And we've seen all of the 8 banks in Hong Kong start to develop very interesting partnerships around the content piece, joint incentives and rewards, social engagement, referral agreements, product delivery, particularly on the payments front, and then product development. And partnerships, which actually was discussed in the panel before with the bankers, is a very key way to move forward, but also one that's quite difficult. You're dealing with fintechs and partners that are a lot more aggressive and innovative in the way they want to scale, and banks which are a lot more risk averse, concerned about customer data, cybersecurity. It's a difficult trade-off to manage. We actually just launched a white paper yesterday with Hong Kong Central Bank, the Hong Kong Monetary Authority, the Hong Kong FinTech Promotion Roadmap. And the whole purpose of this was designed to look at where are the problems facing both the fintech providers and the incumbent banks with respect to onboarding and integrating new fintech solutions. And it sounds nice in principle, but the reality is it's extremely difficult to find a meeting of minds across their journey of working together as well. And then, of course, I think the holy grail for all of this is to develop those partnerships into a closed ecosystem, to create a one-stop shop super app. We all have app fatigue. We don't want to go on 50 different apps to order our food, to book a car, to go to the movie, to pay for something. If all of that can be parked in one single point of contact in one place, that is the kind of utopian vision that all of these banks and super app providers want to move to. And this is particularly where you see players in Southeast Asia like Grab. They're really making a push to develop the super app proposition. Okay, sounds rosy. It's not all rosy. Let me kind of lift the veil on what's going on behind the scenes with these banks. Medium blue, you can see the revenue. Orange, or the gray, you can see the profitability. So despite what you have taking place in markets like Japan or mainland China or South Korea, so those were the first 3 markets to launch digital banks. The rest of the digital banks in APAC are still struggling to turn a profit. It's not an easy journey, whether you're in developing Asia or in markets like Hong Kong, Singapore, Indo, Malaysia, Philippines. The journey to profitability is not so easy. This is just the Hong Kong digital banks. This is their cumulative losses for 2020, 21, and 22. So the average cumulative loss over those 3 years for each of the digital banks is 148 million US. That's a painful number. So there's a lot of money being burnt. The key question is, can this be turned around? And actually, what is behind these losses? So let's have a look. I think what was mentioned before in the first panel was around the cost of customer acquisition. And I agree, for traditional banks, it is extremely painful. But it's not so cheap for the traditional banks either, with all the Facebook ads and Instagram and so on. So when we look at places in frontier markets in Asia, we're seeing the customer acquisition cost oscillate somewhere between about $1 to $5 US per customer to bring on board. When we go to more developed emerging markets, anywhere between $15 to $50 US to bring on a customer. And when we're talking about developed markets, we're literally looking at almost up to $100 US to bring on one customer. Extremely expensive. Why? Because you're offering referral, joining rewards, placement fees, production costs, agency fees, all the ads that you can possibly muster up. It's not a cheap exercise. The other part of it is a lot of clients are actually dormant. Once they sign off and get their reward, they end up not using that bank account. And this has been a very persistent problem with a lot of banks across the entire region. Just taking on the right-hand side, Hong Kong, this is the dormancy rate. And what I mean by dormancy is if you don't log on your account at least once a month, you're considered dormant. Average dormancy rate, 55% of people that have set up a bank account in Hong Kong, has 1.5 million customers, don't even log on their account once a month. One bank, the dormancy rate is over 80%. The other side of it is a lot of these banks are struggling to amass a deposit base comparable with the incumbents, that they actually have the firepower to be able to lend as aggressively. You can see these are the average deposits per customer in developed APAC, emerging markets, and frontier markets. Again, I know I give you data about Hong Kong because we are based in Hong Kong, so that's most visible for us. But I was just speaking to one of the bankers outside. Have a guess what the average deposit is at an HSBC retail bank in Hong Kong. Does anyone want to hazard a guess? Sir, I'm going to point at you. In US dollars, what is the retail deposit? Not high net worth, but average retail deposit. 5,000 US, you said? The average retail deposit at HSBC in Hong Kong is 65,000 US. What do you think the average retail deposit is at one of the virtual banks? It's about 3,000 US. You're dealing in a factor or a scale of 20x. So there's a huge amount of idle money. Different market dynamics, admittedly, to Bangladesh. But the whole idea is, if we don't have the balance sheet to lend, how do we drive a big part of our interest-based business? So it becomes challenging. And then I think you've got some overarching challenges as well. Trust, very important. One of the things that was mentioned this morning, data protection. Breach of data at one of these digital banks, it's game over. Talent management. You're actually seeing a lot of change going on. The talent war is very difficult to find the relevant people to come on and build these organizations. And they're costly as well. The other side of it is usually as a FinTech, as a startup, as a new bank, you have to compete with incumbents with much deeper pockets who are paying people through the nose. And then, of course, you have competition. I remember when all the digital banks launched in Hong Kong, they were offering really high interest rates and zero transaction fees. And guess what HSBC and everyone did overnight? Turned off their transaction fees and said, good luck competing with that. See how you go. Now, of course, it's not all a somber picture. There are some success cases, and there are some really interesting propositions that have been developed around the world in terms of the digital banking models. So I'm going to take a few of the digital banks, not just in the region, but also globally. And you can see here we kind of segment them on two offerings. One which is really the product and service offering. Are they more fee-led in nature, or are they more credit-led? And then on the other dimension is the customer focus. Are they more retail-focused, or are they more SME-focused? So let's go through each of these in a bit more detail, because all of them are now profitable. So what sat behind the profitability? WeBank is the digital bank in China. They have absolutely crushed it and done a phenomenal job. And you can see here that their net profit came in at about $1.5 billion US at the last financial year. They were doing a very, very good job, and one thing that they benefited from was the parent brand integration with WeChat, the actual messaging app. So that made it a lot easier in terms of the dispersion or access to the customers. But they also were to leverage a lot of the transaction data from WeChat, WeChat Pay to start to build their credit scoring capabilities. And what was really interesting is with their business model, they went in a sharing arrangement with other banks. So they didn't wear all the balance sheet risks themselves. They would split it with other banks that wanted that credit exposure at defined ratios, and then they would also take a 10% channel fee. So it was a very interesting model, almost hedging that credit risk. Risk management, 400 risk control models, over 100,000 risk parameters. They can approve loans, I remember hearing before, in as little as 2.4 seconds to approve a loan. And then, of course, they've done a very good job in selectively moving out and expanding into new markets. So this is the case of WeBank, 360 million retail customers and 3.5 million SMEs. Kakao Bank, South Korea. So what did Kakao do? So again, similar to WeBank, they were able to leverage the penetration that Kakao Talk had, their messaging app, with the local Korean diaspora. And they amassed 350,000 users in 10 days. That's pretty fast. And then 10 million in 3 years. Now they have 20 million. But they did a really good job with the gamified user experience. They focused really intently on the UI and UX and the social engagement of using Kakao Bank. And they basically provided a very broad product suite, debit card, remittance, a lot more. And then they started to diversify their incomes through things like mortgages, overdraft, and other types of credit. So it was basically a broad-based play, but this was a bank that focused a lot more on the gamification aspect and really its core products as credit. Then we take another example. This is Oak North. This is an SME bank in the United Kingdom. They just do SME. They're not trying to be all things to all people. They turned around a profitable business model extremely fast. So all credit focused. They focused on developing one of the most robust credit scoring capabilities in the market. And then they also extended collateralized loans and positioned itself as a senior secured creditor. One of the things that was very interesting is when it comes to their offshore expansion, because of the strength of their credit model, they started to say, well, instead of us offering lending offshore, why don't we create a BaaS model, banking as a service, and license that credit scoring capability to other banks looking to further extend their balance sheet into the SME customer base. Airtel. So a bit closer to home, we look over to India. So Airtel Payments Bank. They attracted over 43 million users, turned a profit in 5 years of operations. But again, they went through quite a lot of financial pain in their early years, losing fairly sizable sums of money. But again, Airtel was one of the largest telcos in India. So they were able to leverage on the distribution and customer access that the telco had. They offered a very aggressive interest rate to attract deposits into their bank, and they had a network of over 200,000 merchants. So the whole idea was payments, payments, payments. Let's make our money through payments. The other interesting thing is instead of building all of their core capabilities internally, they partnered with different third parties and cross-sold their offerings into the Airtel Bank network. So it became a different business proposition, payment-led, cross-sell, ancillary offerings. So again, a slightly different model, but one that was able to turn a profit. And then finally is Starling Bank. So Starling Bank is more like a universal bank, all things to all people. But they went through a very interesting journey. And the one thing that I'll call out here is while they had a multi-product and multi-service offering, their focus was not just on breadth, it was about the depth of the relationship. So when you look at the kind of customers, they were targeting older, higher balance customers rather than a Revolut in the UK, one of their competitors. More affluent people. Average deposit, 2,600. A Revolut, the average balance is like £300. So it's very different. They built a marketplace of third-party offerings for their SME proposition. And they integrated with things like Slack, Xero, QuickBooks, all the accounting software, where if you get that two-way payment information, it's a gold mine in terms of the ability to lend against it. Switching schemes. So they spent a lot of time actually basically incentivizing SMEs to pull away from their existing providers. And then they also got into the government-backed loans. Admittedly, very low margin business, but one that was able to scale their balance sheet quite significantly. And finally, they got into something a little less sexy and very basic, mortgage lending. They acquired Fleet Mortgages, 2021, and they grew their mortgage lending practice to almost $1.5 billion US. So how do you sum all of this up? Key takeaways: Cacao, gamification, diverse credit offerings, Airtel, parent brand integration, customer usage frequency. How do you get people using this as often as possible? WeBank, very advanced risk modeling and a streamlined customer experience, and the risk sharing capability was quite key. Starling, quality over quantity, and very opportunistic lending in different segments. And of course, Oak North is really strong cost discipline and very robust credit scoring. So again, quite a different takeaway about each different virtual bank and how they carve their path to profitability. Now, I'm not going to go on a big marketing rant for what we do, but we work with a lot of the incumbent and the digital banks, not only here, but globally. Payment providers, we do projects on CBDCs. We worked with the applications of quite a few of the digital banks here in the region, and we've supported a number of the digital banks on their scaling efforts. Now, we know Bangladesh opened their license application process in June. I believe the original window was supposed to close August 17th, and it was extended maybe by a week. I don't know the exact number. And I think it was about 51 applicants to this point. So these were some of the takeaways. What were the operation details? Of course, you can have a head office, but you do not have branches. Your payment product offerings, you can issue virtual cards, QR codes, other tech-based products. You can also do remittances. And then your lending product offerings, no foreign trade finance, but a lot of other things on the table. And of course, these were some of the requirements that we understand from the current licensing process. Now, I think it's a very exciting time for Bangladesh in terms of these new digital bank offerings coming to market. But it's also something that needs to be very carefully thought through. Otherwise, you're going to end up in situations like many of these other digital banks, burning through cash, not turning things around, and ultimately not making a profit. At the end of the day, the purpose of launching these digital banks is for the benefit of the average Bangladeshi, the retail customer and the SME customer. And ultimately, if you're benefiting them and you can streamline that experience, the operations, hyper-personalize, it will be a fundamentally different proposition to the Bangladesh market. Now, this is obviously way too small, and we don't need to go through any of that, but when we look at the journey in a nutshell, you have to get these things right. What's the strategy to get acquisition up and running? How do you monetize them? Your balance sheet-led business, your fee business, how do you cross-sell? And there are some superchargers here around your third-party partnerships, your ecosystem and platform proposition, as well as your potential geographic expansion, be it within Bangladesh or around the subcontinent region.